Passive income is a great way to earn money without having to put in too much effort. One way to do this is by using debt as a tool to generate passive income. We will discuss different ways to make money passively with debt. We will cover various topics such as investing in rental properties, peer-to-peer lending, investing in dividend-paying stocks, and more. Chapter 1. Investing in rental properties. One of the most popular ways to generate passive income is by investing in rental properties. Here are some tips to help you get started. Research the market. Before investing in rental properties, it's important to do your research. Look for areas with high demand for rental properties, low vacancy rates, and good rental yields. Choose the right property. When choosing a property, look for one that is in a good location and has the potential for long-term capital growth. The property should also be easy to maintain and manage. Calculate your expenses. Before investing, it's important to calculate your expenses, including mortgage payments, property taxes, insurance, repairs, and maintenance costs. Make sure you have enough cash flow to cover these expenses. Hire a property manager. If you don't have the time or expertise to manage the property yourself, consider hiring a property manager. They can handle everything from finding tenants to handling repairs and maintenance. Be prepared for unexpected expenses. Rental properties can be unpredictable, so it's important to have a contingency plan in case unexpected expenses arise. Make sure you have a reserve fund to cover any unexpected costs. Chapter 2. Peer-to-peer lending. Peer-to-peer lending is another way to generate passive income using debt. Here's how it works. Sign up for a P2P lending platform. There are many P2P lending platforms available, such as Lending Club and Prosper. Sign up for a platform that suits your needs and invest in loans that match your risk profile. Diversify your portfolio. To minimize risk, it's important to diversify your portfolio by investing in multiple loans. This will help reduce the impact of any defaults or late payments. Monitor your investments. Keep an eye on your investments and make adjustments as necessary. If you notice a particular loan is performing poorly, consider selling it and reinvesting in a more promising loan. Understand the risks. Peer-to-peer lending is not without risks. Borrowers may default on their loans, leading to a loss of principal. Make sure you understand the risks before investing. Chapter 3. Investing in dividend-paying stocks. Investing in dividend-paying stocks is another way to generate passive income using debt. Here's what you need to know. Look for stable companies. Look for companies with a long history of stable earnings and dividends. Avoid companies with a high debt-to-equity ratio, as they may be more vulnerable to economic downturns. Diversify your portfolio. To minimize risk, it's important to diversify your portfolio by investing in multiple stocks. This will help reduce the impact of any dividend cuts or stock price declines. Monitor your investments. Keep an eye on your investments and make adjustments as necessary. If you notice a particular stock is underperforming, consider selling it and reinvesting in a more promising stock. Reinvest your dividends. Reinvesting your dividends can help boost your long-term returns. This will allow you to buy more shares, which can generate even more dividends in the future. Chapter 4. Investing in real estate investment trusts, REITs. Real estate investment trusts, REITs, are another way to generate passive income using debt. Understanding REITs. A REIT is a company that owns and operates income-generating real estate properties. Investors can buy shares in the REIT and receive dividends from the income generated by the properties. Types of REITs. There are two main types of REITs: equity REITs and mortgage REITs. Equity REITs invest in and own income-producing real estate properties, while mortgage REITs invest in mortgages and other debt securities related to real estate. Diversification. Investing in REITs can provide diversification to your portfolio. as they are often invested in multiple types of properties, such as apartments, office buildings, and shopping centers. Risk management. REITs are typically managed by experienced professionals, which can help reduce risk for investors. Additionally, many REITs have a long history of stable dividends, making them a reliable source of passive income. Tax benefits. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, which can provide tax advantages for investors. Research and due diligence. As with any investment, it's important to do your research and due diligence before investing in REITs. Look for REITs with a strong track record of dividend payments and a diversified portfolio of properties. Chapter 5. Investing in Exchange-Traded Funds, ETFs. Exchange-traded funds, ETFs, are another way to generate passive income using debt. Here's what you need to know. Understanding ETFs. ETFs are investment funds that trade on stock exchanges like individual stocks. They are typically designed to track the performance of a specific market index or sector. Diversification. ETFs provide investors with instant diversification, as they typically hold a basket of stocks or other assets. This can help reduce risk and increase potential returns. Low cost. ETFs are typically low-cost investments, with expense ratios that are much lower than actively managed mutual funds. Dividend payments. Many ETFs pay dividends to investors, which can provide a reliable source of passive income. Research and due diligence. As with any investment, it's important to do your research and due diligence before investing in ETFs. Look for ETFs with a low expense ratio, a diversified portfolio, and a track record of stable dividend payments. Chapter 6. Investing in corporate bonds. Corporate bonds are another way to generate passive income using debt. Here's what you need to know. Understanding corporate bonds. Corporate bonds are debt securities issued by companies to raise capital. Investors who buy these bonds receive interest payments on a regular basis, typically every 6 months. Credit rating. Before investing in corporate bonds, it's important to check the credit rating of the issuing company. Companies with a high credit rating are less likely to default on their bonds. Interest rate risk. Corporate bonds are subject to interest rate risk, which means that changes in interest rates can affect the value of the bonds. When interest rates rise, bond prices typically fall, and vice versa. Diversification. Investing in a variety of corporate bonds can help reduce risk and increase potential returns. Research and due diligence. As with any investment, it's important to do your research and due diligence before investing in corporate bonds. Look for bonds with a high credit rating, a reasonable yield, and a diversified portfolio. Generating passive income using debt can be a great way to earn money without putting in too much effort. By investing in rental properties, peer-to-peer lending, dividend-paying stocks, REITs. If you like the video, please hit the notification bell. Please subscribe to this channel for future video when they become available.